This is David Das from thinkandretire.com, and today I want to talk about how I made over $10,400 in 1 month setting options when the stocks were down. Today I will talk about an advanced option strategy. It's based on selling options. This is a capital intensive strategy. That means it will need a large account size. I will talk only about the practical applications. There are a lot of theories available online. Watch the video till the end, and I have provided about 22 basic options learning topics that you can find and you can learn at your own leisure. I have used one of my larger accounts for this strategy, and if you have a smaller account, you can scale it down. And I have provided some tips for smaller accounts at the end of the video. Your account will also require proper approvals before you can implement this strategy. I have opened and closed 9 positions this month, in the month of July 2022, which I will explain in details. This is a high risk strategy. After I have gone through the trades, I have given an example of the risks involved towards the end of the video. Please try to understand before you invest your own hard-earned money. As this is a complex strategy, this video will be a bit longer than usual. Please bear with me. I'm sure you will find the information helpful. There is a lot of math involved. Please be patient. If you're new to options, please try to understand the mechanics of the strategy first. And if you cannot follow me the first time, you can pause and rewind the video. And if you have any questions or comments, please write them down in the comment section below. But I can tell you one thing, that I did not go to school to learn this strategy. If you have the desire to learn, I'm sure you can master this strategy. The rules followed are applicable to options traded in US and Canadian exchanges. A short disclaimer, this video is for educational purposes only. I'm not a financial advisor. Please do your own research before investing your own money. There is a high risk in options trading. If you are new, please practice with a virtual trading account before you invest your own money. Let's talk about trade number 1. You can see this daily chart of the stock UPS. It's a reputed, well-known company. And on 5th of July, I opened a position. The stock was trading at $183.01. So if you look at the chart, that was on this day, which is 5th of July. And we are talking about weekly options. And 5th of July was Tuesday. Weekly options expire on Friday. So that will be expiring on July the 8th. So I have 3 days to expiry, which is the reason I said DTE as 3. And I sold 180 put contracts, 10 of them at $1.30. The delta of the option was 0.19 and implied volatility was 41%. One option contract is 100 shares. So money deposited in my account will be $1,300 minus the commission. And that includes 10 contracts times 100 shares times $1.30 per share. So that's the amount minus commission was deposited in my account. It means the broker will block $180,000 in your account just in case if this option is assigned on the expiry date. And I will explain that to you later. What does that mean? And as I mentioned before, these are the weekly options. It has the highest theta decay, and every option involves 100 shares. You might ask why I picked $180 strike price. The reason was I do not mind owning UPS shares at $180 if my options are assigned on the expiry date. I also want to have my delta between 0.15 and 0.35. My goal is to get about 1% premium per week. So for $180 strike price, 1% is $1.80 premium in 5 days, Monday to Friday. I'm happy with $30 premium from Tuesday to Friday. I do not want to be too greedy with premiums. I avoid crazy stocks and options which have excessive premiums. As soon as the position is opened, I place a close order, which is a buy order, at about 60 to 80% of the max profit. In this case, I put a buy order at 40 cents. After 2 days, on July 7th, the option price fell from $30 to 40 cents, and my position was closed. And the broker released the whole amount of 180K. So as I have shown before, my net profit was $855.07. And I will show you how I calculated that number. So the credit, when I sold the options on 5th of July, 10 contracts, 100 shares per contract, $30 is $1,300. Commission was $22.48. So the net credit was $1,277.52. On 7th of July, I bought the contracts back at 40 cents. So the net debit is 10 contracts times 100 shares times $0.4 is $400. Plus I have to pay a commission, which is $22.45. So the net debit was $422.45. So the net profit is net credit minus net debit, which is 1,277.52 minus 422.45 is 855.07. As you can see, the commissions are extremely high, as this account is with a large Canadian bank. At present in Canada, Interactive Brokers have the cheapest commissions for options trading. If you want to open an account with them, there is a link in the description box below where you can win up to $1,000 worth of IBKR stock. If you are in the US, there are many zero commission options. Going back to this chart, I do not mind owning 1,000 shares of UPS stock at $180. If I change this chart to a weekly chart, you will see that $180 is about here, which is at a support level, which was a resistance about a year ago. Again, this is not a recommendation to buy or sell any securities. Please do your own research and invest your money. Some of you have guessed it right. The strategy that I'm talking here today is called cash secured put. If you want to learn about options, I will highly recommend you start with these 5 topics. What are options? How the pricing works? What are the intrinsic and the extrinsic values of the options? The call options and the put options. There is a lot of information available online, and you can study and learn at your own leisure. The second trade was on stock Boeing, ticker symbol BA, and you are looking at the daily chart of Boeing. And this is the calendar of the month of July. So I have opened the position on 6th of July, which was Wednesday, which is here. And my option was expiring in 2 days. So I was looking at July 8 expiry. At the time, Boeing was trading at $136.15. So I sold $130 put option, 10 contracts for 75 cents. The delta was 0.18 and implied volatility was 62%. On July 6th, the candle was red, and I was expecting the price to move up or at least be above $130 on the closing of Friday, July the 8th. The money deposited in my account equal to 10 contracts times 100 shares times $0.75 is $750 minus the commission. Next day on July the 7th, I bought the options back at 25 cents. So I had a profit of $0.5, which is about 67% of 75 cents. Net profit after commission was $455.08. The next set of topics I will suggest is to understand in the money options, out of the money options, at the money options, how the options premium work, strike price, how options expire worthless, and what does it mean for options exercise and assignment. Trade number 3 was also on Boeing stock with the ticker symbol BA. And you are looking at the daily chart of the Boeing stock. And I opened the position on July the 11th, which was Monday, for an option which was expiring on Friday, July the 15th. So I have 4 days to expiry. The Boeing stock was trading at $135.52, and I sold 10 contracts at $130 strike price, which was a put option, for $1.60. The delta of the option was 0.26. Implied volatility was 62%. So you can see the red candle on 11th of July, and I was expecting the stock to go up and close above $130 on the expiry date, which was July the 15th. The reason I picked $130 is I do not mind owning 1,000 shares of Boeing at $130. If you look at the weekly chart, $130 is here, which is kind of a support if you look at the bigger picture. So the money deposited in my account would be $1,600 minus the commission. And the money blocked in my account is $130K. Next day, on July 12th, I bought the options back at 40 cents with a net profit of $1,155.06. The third set of topics that I will recommend are options delta, implied volatility, historical volatility, implied volatility percentile, which is called the IV percentile, and the expected move. Trade number 4 was on stock PayPal with the ticker symbol PYPL, and you're looking at the daily chart of PayPal. On July 11th, which was Monday, PayPal was trading at $70.82, and I sold 10 contracts of $67.5 strike price, which was expiring in 4 days at 75 cents each. The delta of the option was 0.24, and the implied volatility was 77%. This red candle shows the stock price on July 11th, and I was expecting the stock to go up or stay at least above 67.5 at the close of Friday, July the 15th. As the stock price was rising, as we approached the expiry date, I let the options expire worthless to keep the max profit and avoid the second commission of buyback. I have explained later what does it mean when the options expire worthless. So the net profit after commission was $727.53, and I didn't have to buy the options back because it expired worthless. Hope you're getting the idea, maybe sort of. And the topics that I'm mentioning here for you to learn will really help you in become a master for options trading. If you want me to make a detailed video of this strategy, please let me know in the comments section below. The next set of topics: theta decay or time decay, days to expiry, weekly options, open interest, and options buying and selling. Search these topics online. You will find tons of information and you can learn at your own leisure. But I can assure you, if you have the desire to learn, you can master this strategy very well. And I wish you all the best. Now let's look at the last 5 trades. I will go through them very quickly here, and then I will go to the charts. Trade number 5 was on Netflix. Then it was Apple, then T-Mobile, NVDA, and trade number 9 is Meta, which is the new name of Facebook. Now let's go to the charts and have a look at them. This is the daily chart of Netflix. And on 14th July, which was on Thursday, I sold $170 strike price put option at 70 cents. And at the time, the Netflix was trading at $175.90. So let's look at the chart on 14th of July. So this was where I sold put options, and I was expecting the price to rise. So on Friday, which was on 15th of July, the price closed above 170 and my option expired worthless, so I kept the full premium. The trade number 6 is on Apple. So on 18th of July, which is on Monday, I sold $145 strike price put at $1.40 when the stock was trading at $147.22. So this was the day, the red candle, as you can see, and I was expecting the price to rise on the expiry date. But I did not wait that long. On 20th of July, I bought the options back at 20 cents with a net profit of $1,155.06. The next trade was on TMUS. It was trading at $133.10, and the date was 21 July, which is on Thursday. So the option is expiring on 22nd. So that's only one day that you can see as a DTE. I sold 20 contracts of $131 strike price at 55 cents per share. So let's look at 21st of July. So that was the red candle. And I sold $131 strike price put options. And on Friday, it closed above 131. So my option expired worthless and I kept the full premium. The next trade was on NVDA stock. The stock was trading at 168.15 on 25th of July. And I sold 160 strike price put options, which was expiring in 4 days at $1.75 per contract. 2 days later, on 27th of July, I bought those options back at 30 cents, giving me a net profit of 2830.01. So on 25th of July, that's the candle, I sold the option, and on 27th of July, I bought the option back. The last trade of the month was on Meta, which is the new name of Facebook. On 28th, it was trading at $158.40, and I sold 20 contracts at $155 strike price, which was expiring in 1 day at a price of $1.35. But on the same day, I bought it back at 60 cents, which gave me a net profit of $1491.28. And if you look at the chart on 28/7, which is the 28th July. So I sold and bought on the same day. This is a summary of all the trades on cash secured puts in July of 2022. 9 trades, and the total profit, if you add them together, after commission is $10,401.68. I will talk about more strategies in my future videos. Subscribe to be notified when I publish new videos. Tips for smaller accounts. So either you can reduce the number of contracts, or you can focus on stocks that trade below $50. For example, if you sell 2 put contracts at $180 strike price, your capital requirement on a cash account will be $36,000. In contrast, if you sell 2 put contracts at $40 strike price, you will only need $8,000 in your brokerage account. I hope that was useful. Let us talk about the risks involved with the cash secured put strategy. We will take the UPS example where we sold 10 contracts for put strike price of $180 on Tuesday, July the 5th, and the option was expiring in 3 days on July 8th. So 3 things can happen with the UPS stock on the July 8th date. UPS can close above 180. In that case, the put option will expire worthless, and I keep the maximum profit minus the commission. The second option is UPS closes at 180. The put option expires worthless, and I keep the full premium minus the commission. If on July 8th, UPS closes below 180, the shares will be assigned. It means the broker will automatically deduct $180,000 from my account, and they will give me 1,000 shares of UPS. If the stock closes at 175 or 170, the broker will still charge me $180 per share because that was the strike price. Now imagine next week some bad news comes out and the UPS trades at $1.50 per share. So my 1,000 shares will now have a market value of $50,000, for which I paid $180K. And if the stock price goes to 0, then I lose all $180,000. This can actually happen to any stock that I buy or we buy normally. I'm going to link to a couple of videos in the description box below. One of the videos will be titled Simple Millionaire Formula for Beginners. And the second one will be how to pick stocks as a teenager in less than an hour. If you found this video helpful, be sure to hit the like and the share buttons. I plan to make more videos with new strategies. If you want to be notified when I publish new videos, please subscribe and press the notification button. If you have any questions or comments, please let me know in the comment section below.